Hello, everybody, and welcome to the State of the Market webinar. Today, we're thrilled to have you all here. Before we get started, we'll give folks a few more seconds to join our virtual room. Would love to hear where y'all are tuning in from. I see Preston's in from Dallas. I'm in from snowy Seattle. We're getting some flurries, so I can't complain over here. It looks like Stevie is in Orange County, California. Cameron, what are you sipping on this morning?
I got two cups. One, I've got my, of course, coffee cup, and then my arrived Yeti. Love this thing.
What's in the arrived Yeti this morning?
Just warm water. It's cold.
I know it's chilly. I think it was in the mid to late 20s this morning, so it's definitely chilly.
Yep. I salted my driveway yesterday, so hopefully no ice.
It's cold. I see Lee's in South Dakota. Real cold. Knoxville.
Yeah. That's snow over there.
Yeah, Arkansas is expecting snow. Looks like Ronnie's in San Fran. Knoxville, Tennessee. We love that market. Fair Oaks, California. A whole host of folks today. Looks like we're coast to coast, so I love to see it.
Jim or Nancy, welcome back.
Good to have you. Awesome. Well, we'll go ahead and get things started here. This is our second ever State of the Market webinar. Last time we had feedback from folks that they would like to be able to see what we're talking about. So we did build a deck out for this one. So Cameron, do you want to briefly introduce yourself and then I'll hit my intro?
Yeah, sure thing. Great to be here today. Thanks so much for attending. So my name is Cameron Wu. I am our VP of Investments at Arrived. And kind of the short background is that I come from a family of real estate entrepreneurs. I grew up in Texas. I have a law background, but was never a practicing attorney, but always in the business of real estate. So I joined Arrived in April of 2021, kind of when we started the beginning to sell shares of rental homes out to the community. So excited to be here today, and thanks for joining again.
Wonderful. Cameron, so thrilled to have you as always. And again, my name is Corinne Headland. I lead our investor relations team here at Arrived. So my goal is to make sure all your voices are heard, as well as my two other Arrived employees, the dogs today. So I apologize in advance, but we are excited to have everybody. Quick agenda for today. Cameron's going to walk through the state of the market as a whole, the economic activity, and then the impact it'll have on Arrived. So Cameron, I'm going to kick it right over to you and check on the pups real quick.
Yeah, sounds good. So today I just wanted to give a brief overview of some of the macro things that are happening that impact Arrive, the real estate markets, and everything going on. So we're going to talk about mortgage rates, just general economic activity. And what I mean by that is we'll talk unemployment, trends, remote work, things like that. And then we'll talk some about the real estate supply and demand. So what are those real estate specific factors that are impacting the market? What does activity look like? And what are we seeing on the investment side at Arrived? And then after that, we'll be going into more that impact on Arrived with rental operations. What are our strategies given the economic landscape? So first, let's talk mortgage rates. Okay, so this has been probably the biggest driver of the change in economic activity and real estate prices over the last 6 months. And we've experienced historic low interest rates for the last 12 years or so. Personally, I locked in a long-term 30-year mortgage rate at sub 3%. And with the economic activity today, I'm probably, not willing to sell that house for quite a long time because I would have to get rid of that mortgage and trade into something else. So mortgage rates have a huge impact on all real estate activity, and they've been on the rise. So usually there's a spread between what are called risk-free rates, so government rates. And there's short-term rates, there's medium-term, and there's long-term government rates. But those are generally known as the risk-free rates. And mortgage rates, there's built in a risk premium. So it's called a spread, right? The risk of default. And that's how you arrive at an interest rate. So with mortgage rates really increasing over the last 6 months due to inflation, due to changes in Federal Reserve policy, we've seen affordability issues. So that's really been the big story here is the change in interest rates, right? As far as the impact on all real estate activity. we've seen the mortgage rates for our own products increase substantially over that same period of time. Earlier in the year, we were able to finance properties sub 4%. So it was a really great time to take out leverage and get that economic thesis of levered equity appreciation at a cheap cost of capital. So when we're earning more than the cost of borrowing, it's called positive leverage. And um, strategically, you want to be able to take out as much, conservative debt that you can to be able to benefit from that. And then very quickly, we saw those interest rates kind of get out of control real fast. The markets were increasing pretty quickly. I remember we had gone from that sub 4% rate, and we were notified that our new rate was 5%. So the mortgage markets were turning very quickly, and this was back in April. Like we had gotten wind of it a couple months earlier that there would be interest rate hikes, but we really felt it later in that year. So it's really changed our whole buying strategy and how we view which investments we're going to get into. But we'll talk about that later with the impact on Rived. Next, economic activity. So there's a couple of important things here that I think are interesting that will impact, what will the real estate activity look like. So most of the talk has been about recession, and it is likely that we'd be leaning towards at least flatlining. We've seen a really great growth over the last 2 years, despite whatever COVID, impact has had. But that seems to be largely, again, driven by interest rates. So one of the kind of trends that I wanted to note was some of the employment activity going on at big tech companies. Here in Seattle, we get exposed to a lot of the tech, but I think it's kind of a bellwether of where the economy is going. So large tech companies are typically a big safe haven for certain sectors of the workforce and the economy. But you've heard a lot of the headlines about Meta / Facebook laying people off, Google laying people off. So, even the tech companies, the larger ones that seem like cash cows and infinite growth engines, they've been laying people off. And what that really signals is that there is a change in the market where we're demanding cash flow, we're demanding conservatism, we're demanding fiscal responsibility, because quite frankly, when interest rates are high, it's a very difficult environment to operate in. So you have to be lean, and it breeds better business practices too. So it's great to go through this cyclically, even though there is some pain. So anyway, when the big tech companies, when they start laying off people, it is really kind of a capitulation sign that the growth engine of a lot of money in the economy is going to start slowing down. We've seen reports from China and other manufacturing-based economies that their orders are slowing down, and that was often a leading indicator of what the economic activity will be. So the less that you have people spending, the more that you have interest rates going up, it's going to reduce just overall economic activity. That is what tends to happen. So all that to say is that there is likely to be struggles ahead in terms of both employment, participation rate. I think wages are going to get more competitive as well. We have pretty good employment participation and employment numbers. So our unemployment level is still fairly low. But really the big challenge here is the cost of capital. So all of the asset purchases that were happening with credit, so car purchases, home purchases, just larger purchases that tend to be financed, those have largely, I wouldn't say fallen off a cliff, but they're greatly reduced. So because of that, you can expect that trickle down effect to happen where smaller businesses are closing, people are less employed. So, personally, I would expect a challenging environment over the next couple of years. I listen to a lot of macro stuff that kind of shapes this opinion, but I do think that it'll be challenging. So what are some of the impacts on real estate supply and demand? The one big factor that I do want to talk about really has to do with what's called the interest rate lock effect. So it's kind of intuitive once you kind of understand it, but I was alluding to it with my own personal story about never wanting to sell my house. And that's essentially what the interest rate lock effect is that when you're locked into good financing, it's a strategic asset to hold, right? So in effect, that reduces the supply of the market in terms of available homes, available assets, because whether you want to sell or not, you don't want to give up the financing, right? And that's the strategic part of holding on to it. So everything is shaped off of interest rates, at least in the real estate markets, even something like the supply and demand. So you would think that in a recessionary type environment, there would be a tendency to not be able to forward assets, to have a real slowdown such that real estate prices would go down. But what we're seeing is that there's a counterforce, and it's the lack of supply, because right, price is the intersection of those two forces. So we do see demand, and it's probably stagnating, but supply is the interesting story here in terms of, well, there just isn't that much supply, so we haven't seen prices decrease quite as much. But that doesn't mean that there aren't that it doesn't change your investment philosophy, right? So even if holistically real estate prices don't decrease as much as feared, or kind of what the headlines would make it seem, there are different dynamics that shape our investment strategy. So that's kind of what I want to talk about on the second part. So, like, where do we go from here? This is the state of the market. It seems that the thesis is here to stay. The Fed has indicated that interest rates will continue to remain high to fight inflation. So whether it increases materially, flatline from here, it's hard to say, but nonetheless, interest rates are materially higher than what we've seen over the last decade. So how does that shift what we're doing? Okay, so on the next slide, generally we are talking about how does a potential downturn impact arrived investors? Okay, so three areas that I want to talk about on the next slide. They are rental operations, downside protections that are built into the Arrived platform, and then what is the real estate strategy going forward? Where are we focusing our efforts to remain competitive in the real estate market? So first, on the rental operations side, I just want to go through some of these high level quickly before we get into Q&A. Rental operations, I really refer to what is the rental market. Where's the supply? Where's the demand? Are there more renters? Are there less renters? Things of that sort. And we've seen pretty good demand on the rental side. So it is a seasonal business, but despite that, we've been leasing quite well through November and December. And I think it has a lot to do with our product mix, but nonetheless, rentals tend to be a solid recessionary performer, especially in an environment where interest rates are high, because financing a property is more expensive. Coming up with the down payment is difficult, and then you qualify for less. So when renting is effectively cheaper than buying, when you consider total cost of ownership, there's going to be a substitution into rentals, and that's kind of what we're seeing slowly start to happen. So I worry less about rental operations in a recessionary environment because of that substitution effect. Now, I'm not necessarily bullish on renting a $4,000 long-term rental home. I think that slice of households, they're able to purchase still. They may have the cash to make a strategic purchase. But if we're talking about core housing, suburban housing for kind of your median household profile, I think rentals will often benefit in that recessionary environment. Even if it doesn't mean really competitive growth in rental values, I think there will be higher occupancy, sustained occupancy, because of the demand for that use case of renting and retaining flexibility. Especially when you think about a recession where people may be in transition between different jobs, different cities, different situations. This is the time for change for people. So they will tend to need flexibility, which will often, again, be a tailwind for rentals. Now, downside protections, we can probably answer more of this in Q&A specifically as questions come up, but I want to talk through just a couple of the ways that even in a down scenario, how does Arrived safeguard kind of the core of the investment and protect against tail risk? We often talk about that Arrived tail risk, that it is, we want events that are going to be really negative outcomes to never happen. Now, you can't protect anything in this world 100%. But with that said, we safeguard the investment in a couple of different ways. First, any property that carries debt it's very conservatively underwritten. Most of our mortgages are between 40 to 65%. And when you look at industry norms, it's anywhere from 80 to 90% when you typically lever a property. Um, what that means is that we're going to be able to um, sustain the payments to service the debt through our cash flow operations to make sure that we're always able to pay that loan, continue to hold out, survive, weather the storm, because we have really good debt service coverage ratios. And that's basically just the ratio between all of your cash flow relative to the interest payments for your debt. So we're covered pretty well. And that's what people got into trouble with during the Great Recession, is that the mortgages were expensive and the underwriting quality was very poor. So there was a mismatch between the ability to pay and then the, you know, the loan itself. And that resulted in a waiver foreclosures. That doesn't so much exist today, right? So we have much more responsible underwriting practices, and even more so with Arrived, with that extra measure of conservatism. So we'll be able to continue to service that debt. So the risk of foreclosure, and being underwater or like getting foreclosed on, I don't want to say is non-existent, but it's very, very low given how we've structured the debt. Insurance, of course, we cover all insurance that you would, as a homeowner, carry, plus additional commercial landlord protections that are a little bit more specialized for the economic activity that goes on. So the rental operations or the vacation rentals when it comes to that segment. And then really Arrived as a company is different than Arrived, the, the homes that investors own. They're completely separate LLCs. So when you're purchasing rental shares on Arrived, you're not buying into a fund of Arrived owned properties. You're buying into an LLC that is a property that you own. Arrived is the manager, but you own it. So in the event that there's any sort of restructuring of Arrived or any sort of business operations that would conceivably impact you, your value is protected by the property. It's secured in that. That's what the equity of the LLC is that you own. It's the property. So, important to revisit those as we think about recessionary type scenarios, that we've really thought through the protection of, the debt, the asset, as well as the operations, and how Arrived and your equity as a real estate owner is separate. And next, finally, what's the real estate strategy going forward for us in light of all this? Well, it's pushing us towards a real focus on income generating properties. And traditionally, the Arrived property is pretty balanced between half appreciation, half dividend, kind of core second and third ring suburban areas and major metropolitan areas. It's really your core single family home thesis. Now, as interest rates have gone up across the economy, that risk-free rate goes higher. So there's like a certain demand for higher income, right? Or else, if we're not offering a high enough dividend, then why not just go buy bonds that are backed by the US government? That's what I would do. I would recommend that for all of you as well. So in search for higher yield, we're looking for the properties that are competitive against that, right? So that they offer an attractive spread where you can get more than the risk-free rate significantly and build equity in real estate. So that's what the real estate strategy has been. So it's driving us towards lower price points where there are better ratios between the rent to the purchase price. So for every dollar that you're spending on obtaining an asset, you're able to effectively generate more rent from that. And given the thesis behind kind of strong demand for that rental asset, then we think it's the right match and it's what we're searching. Independent of Arrived, if I was running a real estate fund or buying for myself, these are the strategies that I would employ, because really this whole session is kind of a peek into the thought process of what goes on at Arrived as far as where do we start investing investor dollars. So ground up, we think, okay, this is what the market is telling us. This is what it's pushing us towards. So let's make investments in there. So anyway, that kind of wraps up the prepared remarks. Just hitting about 20 minutes. So I want to take any questions that y'all may have had. And thank you for listening to me for 20 minutes straight as we talk through a heavy topic. But, first it's broad, but I wanted to bring it back down to any specific questions y'all may have now.
Wonderful. Cameron, thank you so much for the prepared remarks. I so appreciate the, 30,000, 40,000 foot view and then drilling it all the way down to Arrived with various topics. So definitely appreciate you walking through it on all different levels. We have quite a few questions that have flown through the chat. As Jake mentioned, our head of operations, he's in the chat answering any Arrive specific questions, and then he'll tee them up for Cameron to answer live today as well, as long as they're market related. So I did see a question in here from Serge, who's been on the last, I think, 3 webinars. So we're thrilled to have you here
Welcome
today.
back.
Yeah, definitely. We do have more properties coming soon, which is what they had asked if we're releasing one today. But Cameron, I think it's a good opportunity to walk through our inventory, essentially how that strategy has shifted, because right now we don't have any properties on our platform available to invest in. So I'd love to see what your thoughts are on how the strategy functions and how we're selective in that process.
Yes, great question. And it's, never a position that we want to be in, right? Where we have demand for properties, but we don't have the supply to provide investment homes. But I think what that speaks to is just our own investment process of being fairly disciplined when it comes to investments that we think are okay. In this environment, our rate where we walk away from stuff is much, much higher right now. There are a lot of deals out there that are, we get into due diligence, they're not worth pursuing later. There's a lot more negotiations back and forth. So the environment is just more volatile right now, and we just walk away from a lot of stuff that we don't feel comfortable with. Our due diligence process is pretty strong in the sense of, like, we go through a lot of title review. We review the HOAs, and we're trying to get great properties, but at great values too. So sometimes that requires a lot more negotiations back and forth and due diligence. So it has, I would say, slowed down our pipeline, especially as we try to offer a newer mix of inventory as well that are aligned with our thesis. So I think that there's been some transition in finding those assets as well. And we're just picky because we say no to a lot of stuff. And I think you just have to do that. We're also small enough where we put a lot of care into every offer that we make. So I think that as we scale out what like the partner network where we're sourcing our new mix of inventory, we're going to have a steadier stream of properties available. But right now we've been shifting the mix towards more short-term rentals and more income producing on the long-term rent. So I would say that that's some of the context for why there is that imbalance right now, or why there is no supply that you see on our website. But quickly remedying that, just want to make sure every investment we put out there is one that that I would stand by.
Definitely. I know last week Quao had talked about it as well when we were walking through the Regal, that was a property that y'all were able to get 275K under asking, but then you've also had properties where you've walked away within 7 days because of termite damage. So the due diligence there is pretty incredible, to say the least, like partnering our tools along with that human touch like you're talking about, Cameron. So definitely more to come. Serge, appreciate the question. We do have one property that's currently on the platform, the Regency, located in Cincinnati, Ohio market. You can click the notify me button for either an email or an SMS text. So more to come. Hopefully we'll release in the next week or so. I did see one in here from Faisal, how to balance picking good properties with Arrive needing to grow. So how do you safeguard against the possibility of getting into bad deals given the demand on the Arrive platform? How does that work, Cameron?
Yeah, I think that having investment experience and knowing the asset type that matches the thesis, that's certainly important. I think your question is more about incentive alignment though, right? To make sure that we're not growing for the sake of growing. And, I can say nice words to have you believe, but I think the fact that we don't have any supply right now, and we get this question every webinar, it's like, when are you going to have more properties? It's kind of a testament to, we're practicing what we're preaching in terms of being selective. We have a lot of offers that we look at. We put in a fair number of offers every single week. And sometimes when you go fishing, you just don't get any bites. So we're working on expanding the number of pipelines, the channels, the number of offers that we can have, but without ever really compromising on the selectivity. So, it's that, I would say that, like, the investment process integrity and just being an investment professional and who we hire, that's part of the team building process. And I think that's some part of a leap of faith that in the beginning is hard to demonstrate without adequate track record. So maybe 5 years down the line, when we look back, we'll feel validated that we got into responsible investments. But as far as also just, other alignment points that I can think of off the top of my head, our part of our compensation at Arrived is funds for property shares. So we invest in all the properties that y'all are seeing on the website. And just the other day on the short-term rental webinar, I think Corinne was even sneaking in some purchases while Qual was talking. So to the extent that, like, even from a comp point of view, we get allocations towards properties, we all invest alongside you, even though Arrived is not explicitly holding it as if it's a fund. The employees are holding it as if we're making every investment with you. So that's another part of kind of the mission alignment. But I think that, part of the exercise is upfront, what you see. Part of the exercise will have to be in the rearview mirror when we're looking back on investment performance. Real estate is a long-term hold. It's a long-term performer. It's got both an income portion and an appreciation portion, and one that is heavily influenced by macro and leverage as well. So there's a lot of different components, but how we are as an overall investment sponsor, I would say that we preach transparency. We've lived it. We send every one of our investments through the qualification process with the SEC. There's links to them. So I think that, that amount of transparency also bolsters it, such that if you want, you can go see every single one of the properties and see the price history and see how much we paid and look at the offering documents. So I think that what is a good deal is kind of in the eye of the beholder. But as far as the things that we can align on, it's certainly transparency as well as, investing alongside with you.
Definitely. Yeah, Cameron, I learned my lesson because we had a new market spotlight a month ago, and I didn't buy shares during the webinar and I missed out because it went so quickly. So we definitely will have more state of the market webinars, market spotlight webinars in the future. Serge, it sounds like you like those. I would love to hear from other folks on the line if you find those beneficial when choosing to invest. I did see one in here from Leslie. Are you steering completely away from some states, markets, and if so, why? Not just in this economic environment, but in general?
Great question. Yes. At Arrived, we have a couple of different investment products, and the way that we see investments is that there's some good investment out there for any market, any state. It just has to be the right match. So I wouldn't say that there's necessarily any area that we're wholesale avoiding. But there are certainly areas that are more challenging to work with for certain products, especially at this phase in our life, right? Of being a smaller company still. So, you know, if we want to talk about long-term rental operations, it's been a challenge to work in some of the larger cities that make the eviction process difficult. So it's very landlord not friendly, which, it's important to balance those interests. But at the same time, as an investment company, you need some measure of certainty and stability with what's going to happen. I think that there are some states that also make it difficult as far as the regulatory environment, whether the operation of, the fractional share and kind of the way we structure LLCs, it may not work for certain states. So we've run into that as well. From an asset point of view, I think there's something out there for everyone, whether it be land, whether it be residential real estate or commercial. The play is out there, from small to big to urban to rural. It just has to be the right match. And at Arrived, I would say that we are not limited or constrained to any sort of standard playbook or standard, vanilla rental income product. Although that is the core of what we offer, our investment products are going to be wide and varied. So I would say that there's definitely markets that don't work for certain investment types, but there's not a single market that I would say we would avoid in totality.
Wonderful. Thanks for walking through it, Cameron. Now we're going to move a little bit to vacation rental outlook for 2023, which I absolutely love what Jeff just asked. Looking forward to 2023 and potential recession, won't the demand for vacation rentals decrease?
I think on a macro sense, yes, that's correct. But even with that said, I think that there are areas where some will do even better because of that. And I think about substitution effects a lot of times with changing economic conditions. People aren't going to all of a sudden stop taking vacations. They'll just substitute into other things potentially. But they're at the same time, overall activity should probably decrease. So that was kind of my initial reaction to your question is, shouldn't it decrease? Well, yes, I think in totality, that's correct. But which areas will not be as impacted? And that's what we're trying to find. So one of those themes is, are you drivable to large population centers? One of the areas that we're targeting is Poconos Mountains, Catskills, those parts of New York and Massachusetts that are, I don't know, 3 to 5 hours driving distance from pretty large population centers. So there's a lot of density up there. Now, whether they will be worse off or better off in a recession 1 year from now, 2 years from now, I'm not entirely sure. I do think that business class vacations to Milan, Italy are going to, from Americans will probably decrease, but I don't know if the net effect of those driving to the Poconos is going to decrease. So maybe occupancy will go up. With that said, it's a nuanced question. It's how we think about things. So we're trying to find the areas that have optionality, have resilience to them, and most importantly, can do well in a recession. There's a lot of different factors, but I wouldn't take it um, for certain that every vacation listing is going to see a decline, but I would bet the market as a whole would.
Wonderful. Thanks for walking through it, Cameron. And I did see a few questions around international investment. So I think it's always great to talk about this too, especially with where we are today. Do you foresee, Cameron, exploring outside of the US? I know Leslie's really interested in a lake in Mexico, which is awesome to hear.
Yeah, I think so. We actually even get propositioned by certain companies who are looking for partners to expand out into international locations where they've already got the operations, they know the market, and they're looking for a partner to get some scale and operations with. So those are opportunities we're evaluating. Every country is going to be different. So, it's not as if we can just deploy the model to the world. I think it would be country by country basis, but certainly some neighboring countries would make sense where there's maybe not as many visa issues, there's not travel issues, things like that. Kind of to the core thesis of, can people go there, and even vacation. So yes, we do like the idea of bringing international investment to the platform. It may be where the growth engine is for the next 20 years, 20 or 30 years as well. So excited about that prospect, looking into it now. Nothing actionable yet, but that could change really quickly.
Wonderful. And I did see, because I know, Cameron, you talked about expansion and markets that you would stay away from. There was a follow-up from Cindy. Which states have the largest issues? And then Jeff had mentioned, this is kind of like twofold, but is Tampa area too expensive for a long-term rental?
Yeah. So maybe the second question first, is I think that's kind of a simpler answer for a simpler reason. So I would say right now, yes, because insurance costs are insanely expensive in Florida. I mean, and I don't use that word lightly when I say insanely expensive. It really prevents us from investing heavily into a long-term rental model there right now. Florida just got battered this year by hurricanes, so the insurance industry is kind of doing a wake up call, just be like, uh-oh, what do we do about this? So right now rates are just really high. It can work still for short-term rentals, and we're underwriting it with those expensive costs in there because it's just such a desirable vacation market for people to go to that it still works. But long-term rentals, yeah, I mean, I don't know how people who are even living there are affording that right now. So that's a challenge. The first question, which states have more onerous provisions than others? So, I'll speak to it in a couple capacities. One of the challenges that we've seen is that, California, for example, they don't recognize certain entities at a large scale. So our Series LLC structure, it's an interesting question that we're going through right now with them. So we've kind of paused on evaluating California. So that's just an example of something at the highest level that can impact the ability to invest there. Um, Other things are more tactical, like short-term rental permits. So certain states are very easy to work with when it comes to their philosophy on viewing vacation rentals. The Maricopa County in Arizona, so it's the Greater Phoenix MSA, they're totally lax with vacation rentals. It's even presumed to be included unless explicitly excluded, right? So you can pretty much turn a lot of properties there into short-term rentals. Other places, though, we offered in Charleston, South Carolina. They have a block of, I don't know, 9 city blocks or so where you, as a non-owner vacation rental owner, so you don't have a vacation rental owner that doesn't live in the premises, there's like 9 blocks where you can invest. So it certain markets for certain products have pretty strict provisions, but I would, as a little bit more color into that, I would say you run into that a lot more in vacation rentals. And then at the state level, not so many things unless it's something like certain restrictions on landlords would say, raising rents, for example. You may not be able to do it every year, which we don't anyway, but I'm just trying to think of examples where at the state level, they would have something more challenging to work with systematically as opposed to something at a market level. So examples of those, but every state's going to have its nuance. But yeah, the typical poster children for difficult environments to work with tend to be true.
Yeah, I appreciate you walking through it, Cameron. I'm seeing Jake filter in a few questions in the chat, so definitely appreciate it. There was one earlier on too, Cameron, around like, do you feel like it's a good time to be buying shares in rental properties, or do you think that folks should hold off? And obviously, we can't give investment advice, but this is your own personal thoughts on kind of the state of market, how it relates to Arrived, and kind of a high level view on that.
Yeah. So I would say that in my life, trying to time the bottom has never really worked out because it's just, it's for a fleeting moment that the bottom exists. Right. And when you're trying to chase it, they call it catching the knife for a reason. Right. You're going to get cut trying to do it. And I think that what the better advice for myself reflecting, in my own life was, when you know that you're in a cycle where it's not going to like run away out of control with prices, it's more like an accumulation phase. So it's not like making a purchase at the bottom, it's more like accumulating during a phase. Now, the funny thing with real estate is that you can't do that really unless you're super wealthy, because how do you accumulate real estate? If you're talking 1 property, 5 properties, or 500 properties at a time, you got to have the capital to do that. So I think that as, as a matter of practicality, that's never really lined up for people. So I think the opportunity does now exist for dollar cost averaging, where you can incrementally invest into a phase and accumulate, because, you think about real estate at 10 years and 20 years at a time. And when you zoom out, then you realize, okay, well, there's maybe 2 years that I'm going to try to accumulate more because prices were low. And then during the next 8 years, when prices are like increasing, then I can change my strategy then. So the idea of Arrived and fractional investing facilitates the ability to even accumulate and dollar cost average in the first place, right? And that's why I find it kind of comical thinking like, oh, dollar cost average like stocks, but you can't really do that as the average person in real estate, much less buy one. So there's always a challenge of like timing the bottom when it comes to real estate, because you're not able to. But now that the opportunity exists in a sense, because you can do it in a fractional way, I think that's a really interesting value proposition, and like general advice that I would give myself, that if I could go back in time and this was available, I would say, well, just generally buy in this period of time, and fast forward 10 years and you'll be doing just fine. So that's what my advice would be, just generally, of investing in a recessionary environment, is that, hey, if prices aren't running away, just put what you can on a steady basis, because you don't know when the bottom is. And maybe there is not even a bottom. I was talking about earlier, some assets, they haven't gone down in price at all. So when we're participating in the $230,000 price point for rentals, they're the same price that they were 9 months ago. So they certainly haven't seen a decrease, which gives me even more conviction of like kind of the strategy of going into it, saying like, hey, this hasn't experienced price decline. people are substituting into it. There's demand for it. There's still 5 offers on this one newer home at the right price point. So that was kind of to re-emphasize the point of like, it's really hard to tell where the bottom is on something like an asset by asset price. So yes, are we in a stagnant period? Fair enough. But I like to think about it like an accumulation phase for real estate. Oh.
There we are. Sorry about that. I did see one flow in from Leslie. Are you still accepting suggestions, having a contest for properties to create? So, Cameron, this is related to the BYOB, the Build Your Own Property. BYO, yes.
Yep. Yeah, the BYO, the build your own. So, vacation rentals is a core part of what we do. And just for everybody's context, we ran a program to have people submit contest designs for what they imagine an awesome vacation rental to be. So we got a lot of great submissions, and we have our first winner, and that person's property is going to be called The Lodge, where it's this really cool outdoor cabiny type concept. So I think that the discussion is that we intend to make it perpetual, like a perpetual part of what we do to get submissions, keep engagement high, and then design out the ones that when we find the right property, and then we're going to match it with the winning design. So yes, I like that part of what we do. I think it's great for engagement. I think it's just also like good market feedback too of what people find desirable.
Definitely. Yeah. I realized I said it should be BYO. But thrilled that you asked, Leslie. It's pretty cool. Internally, we actually joined as a group to walk through each one of the submissions, and the ideas were absolutely phenomenal. I would want to live in almost all of them that came through. So Jake just shared our first winner and then some of the runner-ups as well. So hopefully we'll be offering that again in the future for you all to hop in and share your ideas as we continue to iterate. So if there's any questions that we missed, definitely let us know in the chat. Happy to ask Cameron or tee them up in the chat as well. But Cameron, as we look towards 2023, in terms of, obviously you talked through like strategy, what we're moving forward with, but what about asset class expansion in the current market?
Yeah, so with shifting strategies come new investment classes, new investment products in different markets. So with a focus on income, we're going to have a lot more opportunities to invest in multifamily. So that's duplexes, triplexes, fourplexes, and even smaller apartment buildings, say, so 20 to 30 units, something that's a couple $1 million in the lower range when it comes to multifamily. I think that also opens up different markets that we haven't gone into yet. So some of the larger coastal cities, take your pick at that. They're really difficult to invest in for long-term rentals because the land's just too expensive. But if you were to go into multifamily and get a little bit more density of operations, then you can really start opening up the areas that you're purchasing the assets in, because then that cash flow or that return profile and investment thesis that matches what is going on in the environment right now. So I would expect a lot more income focus, expansion of vacation rentals, and just getting more and more creative with the ideas out there, and really just looking for value add. There's a lot of opportunities in a recessionary environment, especially when you're a cash buyer, which is what Arrived effectively facilitates as a crowdfunding platform. It's like we have the power of cash altogether, as opposed to requiring getting a loan, right? So we need to take advantage of that and get some pretty deep discounts and participate in projects where financing may not be available to the average person. So when you do that, you start opening up different investment products, more like flips and value add building, and making something that was not prior habitable, bringing it back into the market as like a net housing supply. When you do things like that, you have the opportunity to own it for income or even sell it to an owner occupant for a cash gain, right? So those are the things that we're exploring generally with value add and income production. Again, all colored back to that very first part of the segment by the risk-free rate used to be 0. So if you try to borrow from the government, they're not going to pay you anything. They want you to deploy it into the market. Now they're saying, well, it's actually at 4%. So everything else, needs to price off of that. So that's a little bit into the state of where I'm projecting we're going, but who knows? We'll see.
Wonderful. Cameron, I know it feels like the sky's the limit when it comes to asset classes, market expansion, so on and so forth. So, for everybody on the line, we'd love to hear what asset classes you're interested in seeing arrived move into in the future, as well as different cities or markets. So, feel free to drop that in chat. We're building for and by y'all. So, we want to be sure we're hitting that mark and taking your feedback to actively listen and implement. So, would love to hear in the chat. I did see one flow in from Michael that is in regards to long-term rentals. We are right around 5 to 7 years, and then for vacation rentals, 5 to 15 years. So Cameron, perhaps you could, I'm thinking like twofold for this question of why we have each of the hold periods in place, and how it differentiates for each asset class.
Yeah, definitely. So with real estate, there's costs to transacting it in the real world. There's brokerage commissions, title policies that you have to pay, closing costs, etc. So those eat into the margin. So if you sell it for a gain, then you're not going to fully realize that because of the transaction costs. So real estate has historically appreciated pretty well over a long enough period of time, and that's kind of the fundamental thesis of holding real estate longer term. And we just want to make sure that there's a healthy gain when the decision comes to selling the property. So that's kind of the idea of 5 to 7 years. And why longer than for vacation rentals for 5 to 15 years? Okay. It's a similar asset class in the sense that it's underlying residential, that you may have an owner occupant buying it. So, what's so different about the investment thesis of like, why hold it for longer? And the answer really has to do with the income production capabilities and what it takes to get it. So when you're investing in a vacation rental, you got to provide furnishings. There's usually some amenities that you're going to have to spend money on. And the expectation is that you're going to generate higher income over the life. But the problem is that when it comes to that end of that useful life for those assets, it's not like a house and land that tends to appreciate. That couch, the day that you buy it, is not as valuable as as it was on the showroom floor. So when you have a higher investment in personal property instead of real property, that'll depreciate out. So you really need to make use of it over a longer period of time. So that sofa is much better served as an asset in year 10 in your house than the salvage market. So you want to generate the income over that longer period of time. So that's really the fundamental premise of, even though they're the same underlying asset class, why would you hold an income producing asset longer, like a vacation rental? Well, it really has to do with getting the economic value out of the furnishing and playing off that income for a longer period of time.
Wonderful. Thanks for walking through it, Cameron. And as you all know, those holds are flexible given a myriad of different data points and obviously that human touch. So appreciate you walking through it, Cameron. We got some feedback in chat too. Cynthia had mentioned they're interested in multifamily properties. They've purchased, it sounds like thanks for offering properties in Tennessee. I was planning to buy one entire rental property and arrived as a much better fit for me. So thrilled to hear. Trent had also mentioned other asset classes like multifamily that you had mentioned in logistical facilities near metro areas. Interesting. What are your thoughts on logistical facilities?
I am 100% on board. And I think that there's a really good opportunity for repurposing of assets into logistical facilities. Development is one thing, and I think that's a very different game. But I think that there is also some opportunity to like do more of the entitlement and zoning process, separate that out from, say, the development process, which is kind of a different beast in of itself. And then there's the end usage of it, which is, being the landlord to a logistics company or a third party logistics company that is utilizing that warehouse space. So all interesting plays. I really like those types of thoughts because I do agree that the economy is moving towards, consolidation of logistics centers that are kind of around the perimeter of a city. You make transportation cheaper. You make grids. You make electric trucks and everything like that. There will be demand for that type of thing. Even further into the future, let's talk about maybe some commercial buildings that are strategically located that may not have as much use later on. And as drone technology and 1 hour delivery gets better, there may be some interesting business ideas for like launch pads and things like that to repurpose commercial space. So I think all of that's going to happen in the near future, but certainly a more grounded play would be to invest in third party logistics, right? The real estate behind that. So I love that idea.
Yeah, absolutely love it. Great suggestions. And I see Jake also agreed in the chat too, which we love to see. I think we've covered all the questions that have come in through chat. So if we've missed any, definitely let us know. Cameron, coming up on obviously like 2023, we had the founder chat last week, and one of the questions was like, what keeps you up at night, or what are you most excited for as we close out this year and head into the new year? One thing I'll mention is that the growth we've had, obviously, in the last year has been pretty phenomenal. We had 100 properties in May alone, with that 100th being in Nashville, Tennessee, and now we're at 201. So I'd love to hear what your thoughts are as we wrap up the day.
Yeah, so I'm excited for next year about the opportunity to just come in and um, be in a really good position to get a lot of good deals. There's in the last couple months, I've gotten a fair number of calls and reach outs from different real estate companies that seem to be a little bit distressed in terms of like they got caught up in buying too many units. They accelerated too quickly, or for whatever reasons, they're not able to hold on to real estate. So Arrived has grown really responsibly, in my opinion, at least. And I think that we've made really measured and tempered investments and have had really good policies that are like kind of incrementally shift. And I feel like we're in a really good position heading into next year to be able to acquire a lot of good deals. And I guess that's what's exciting. So expansion and growth are going to be in our favor, I believe. So anyway, just kind of a little what I see from a competitive landscape is that I think that we're in a position to accelerate our growth compared to maybe some other players in the industry.
Wonderful. So appreciate you walking through it. Lots more to come as we wrap out the year and obviously head into 2023. So we so appreciate having everybody on board. I just saw one pop in from Cindy as a clarification. So can you explain more about what a logistical property would be, Cameron?
Yeah, I think kind of the idea would be like a Amazon warehouse, right? Maybe not Amazon itself, because I'm sure they have their own internal operations given their scale, but some sort of company that leverages warehouses to, be a place where you dump off all of the product from 18 wheelers. And then from there, you take your more regional servicing trucks to load up that delivered to your address, right? That could be an example of some sort of carrier facility or packaging place or, boxing facility, anything that supports e-commerce more or less in that logistics. I think that's one element of it. The other element, interestingly, might be supply chain support for bringing back some logistics onshore. I think that there's what we saw from COVID was that just-in-time delivery as a concept, which is kind of a just supply chain concept where you run really lean because you get your suppliers to hold the inventory, and then right when you need it, you get it delivered. So all of the delays that we experienced during the last 2 years in COVID are kind of a result from just-in-time logistics, right? Because we manufacture a lot overseas, you bring them in, it's all very tight timelines. And when your port system doesn't work or there's close downs, like you get bottlenecked pretty hard. I think that there is a future for onshoring logistics again, because the supply chain ramifications are dangerous with a globally integrated supply chain, like where it's too just in time, where you really get it's a weakness. It becomes a weakness, not a strength. So you could have third-party logistics where they are just warehousing component parts and then they need to be assembled in the US. Car manufacturing is an example of that, where in the southeast part of the United States. They assemble a lot of cars there. So kind of the old school Detroit and all the auto industry is kind of shifting towards the southeast with like battery manufacturing plants and other like, domestic manufacturing. So any type of that operation would be what I consider like industrial, or a subcategory of that, logistics. But a couple, two separate examples of what that could be.
Wonderful. So appreciate walking through it. Great question, Cindy. If there's any ever asset class questions or clarification, definitely let us know in the chat. And Leslie mentioned, I appreciate you and your approach. Looking forward to 2023 and more great properties. So appreciate the feedback, Leslie. Cameron, any closing remarks before we shut our virtual doors for the day?
No, I really appreciate the time to talk about Arrived and our investment strategy in the markets. Again, I hope this was helpful, but it's a pretty candid glimpse into how we think about navigating everything right now, from the macro economy to negotiating on properties. So thanks for listening.
Yes, Cameron, thanks so much for walking through the 40,000 foot view of your thoughts on the state of the market, and then drilling it all the way down to Arrived, and obviously instilling confidence. So appreciate the kind feedback. I'm seeing we have 2 Leslies in the house. Appreciate the kind words. Serge, Tiffany, Cindy, Michael, everybody else on the line, thanks for spending your Monday with us. Will you have a replay? Yes. So anybody that has registered or attended today, you'll receive a recording via email. It takes a little bit of time to populate, but you should see that in the next few hours. So Jeremy, if you don't, support@arrivedhomes.com is the best way to reach us, or there's a little chat function in the bottom right-hand corner of our platform. But thanks everybody for joining today. Happy holidays. And Jake, thanks for answering all the questions in the chat as well. And Cameron, for all of your time. So we will catch you all later this week.
All right. Thank you all.
Bye all.